Hey friends! Today we are going to start fifth and last course of elementary session, which is popular chart indicators. In this course we will cover below lessons: how to use Bollinger Bands, how to use Keltner channels, how to use the MACD indicator, how to use parabolic SAR, how to use the stochastic indicator, how to use RSI, relative strength index, how to use Williams percent R, Williams percent range, how to use ADX, average directional index, Ichimoku Kinkohyo, trading with multiple chart indicators. What is the best technical indicator in Forex? Summary of popular chart indicators. As you see in this course, there are so many topics to be covered. So we divided this course into two parts. So let's begin the first part with first topic: how to use Bollinger Bands. Congratulations on making it to the 5th grade. Each time you make it to the next grade, you continue to add more and more tools to your trader's toolbox. What's a trader's toolbox, you ask? Simple. Let's compare trading to building a house. You wouldn't use a hammer on a screw, right? Nor would you use a buzzsaw to drive in nails. There's a proper tool for each situation. Just like in trading, some trading tools and indicators are best used in particular environments or situations. So, the more tools you have, the better you can adapt to the ever-changing market environment. Or if you want to focus on a few specific trading environments or tools, that's cool too. It's good to have a specialist when installing your electricity or plumbing in a house, just like it's cool to be a Bollinger Band or moving average specialist. There are a million different ways to grab some pips. For this lesson, as you learn about these indicators, think of each as a new tool that you can add to that toolbox of yours. You might not necessarily use all of these tools, but it's always nice to have plenty of options, right? You might even find one that you understand and comfortable enough to master on its own. Now, enough about tools already. Let's get started. Bollinger Bands. Bollinger Bands, a chart indicator developed by John Bollinger, are used to measure a market's volatility. Basically, this little tool tells us whether the market is quiet or whether the market is loud. When the market is quiet, the bands contract, and when the market is loud, the bands expand. Notice on the chart below that when price is quiet, the bands are close together. When price moves up, the bands spread apart. That's all there is to it. Yes, we could go on and bore you by going into the history of the Bollinger Band, how it is calculated, the mathematical formulas behind it, and so on and so forth, but we really didn't feel like typing it all out. In all honesty, you don't need to know any of that junk. We think it's more important that we show you some ways you can apply the Bollinger Bands to your trading. Note, if you really want to learn about the calculations of a Bollinger Band, check out John's book, Bollinger on Bollinger Bands. The Bollinger Bounce. One thing you should know about Bollinger Bands is that price tends to return to the middle of the bands. That is the whole idea behind the Bollinger Bounce. By looking at the chart below, can you tell us where the price might go next? If you said down, then you are correct. As you can see, the price settled back down towards the middle area of the bands. What you just saw was a classic Bollinger Bounce. The reason these bounces occur is because Bollinger Bands act like dynamic support and resistance levels. The longer the time frame you are in, the stronger these bands tend to be. Many traders have developed systems that thrive on these bounces, and this strategy is best used when the market is ranging and there is no clear trend. Now let's look at a way to use Bollinger Bands when the market is trending. Bollinger Squeeze. The Bollinger Squeeze is pretty self-explanatory. When the bands squeeze together, it usually means that a breakout is getting ready to happen. If the candles start to break out above the top band, then the move will usually continue to go up. If the candles start to break out below the bottom band, then price will usually continue to go down. Looking at the chart above, you can see the bands squeezing together. The price has just started to break out of the top band. Based on this information, where do you think the price will go? If you said up, you are correct again. This is how a typical Bollinger Squeeze works. This strategy is designed for you to catch a move as early as possible. Setups like these don't occur every day, but you can probably spot them a few times a week if you are looking at a 15-minute chart. There are many other things you can do with Bollinger Bands, but these are the two most common strategies associated with them. It's time to put this in your trader's toolbox before we move on to the next indicator. Let's move to the second topic: how to use Keltner channels. Keltner channels is a volatility indicator introduced by a grain trader named Chester Keltner in his 1960 book, How to Make Money in Commodities. A revised version was later developed by Linda Raschke in the 1980s. Linda's version of the Keltner channel, which is more widely used, is quite similar to Bollinger Bands in that it also consists of 3 lines. However, the middle line in a Keltner channel is an exponential moving average, EMA, and the 2 outer lines are based on the average true range, ATR, rather than on standard deviations, SD. Because the channel is derived from the ATR, which is a volatility indicator itself, the Keltner channel also contracts and expands with volatility but is not as volatile as the Bollinger Bands. Keltner channels serve as a guide for setting trade entries and exits. The Keltner channel help identify overbought and oversold levels relative to a moving average, especially when the trend is flat. It can also provide clues for new trends. Think of the channel like an ascending or descending channel, except it automatically adjusts to recent volatility and aren't made up of straight lines. If you've read our lesson on Bollinger Bands, you're probably guessing that Keltner channels are basically cut from the same cloth. Well, almost. What sets these two apart are the underlying indicators and calculations that we could go on and on about, but might lull you to sleep. Let's just say that these formulas yield differences in price sensitivity and the smoothness of the indicators. How to trade Forex using Keltner channels. Keltner channels show the area where a currency pair normally hangs out. The channel top typically holds as dynamic resistance while the channel bottom serves as a dynamic support. How to use Keltner channels as dynamic support and resistance levels. The most commonly used settings are 2x ATR, 10, for the upper and lower lines, and EMA, 20, which is the middle line. This middle line is pretty significant since it tends to act as a pullback level during ongoing trends. In an uptrend, price action tends to be confined in the upper half of the channel, that is between the middle line as support and the top line as resistance. In a downtrend, price action usually hangs around the bottom half of the channel, finding resistance at the middle line and support at the bottom line. In a ranging market, price usually swings back and forth between the top and bottom lines. Let me tell you how to trade breakouts using Keltner channels. Breakouts from the Keltner channel act as strong hints where price is running off to next. If the candles start to break out above the top, then the move will usually continue to go up. If the candles start to break below the bottom, then price will usually continue to go down. Keeping an eye out for these channel breakouts can help you catch a big move as early as possible. How to use the MACD indicator. MACD is an acronym for Moving Average Convergence Divergence. This tool is used to identify moving averages that are indicating a new trend, whether it's bullish or bearish. After all, our top priority in trading is being able to find a trend, because that is where the most money is made. With an MACD chart, you will usually see 3 numbers that are used for its settings. The first is the number of periods that is used to calculate the faster moving average. The second is the number of periods that is used in the slower moving average. And the third is the number of bars that is used to calculate the moving average of the difference between the faster and slower moving averages. For example, if you were to see 12, 26, 9 as the MACD parameters, which is usually the default setting for most charting software, this is how you would interpret it. The 12 represents the previous 12 bars of the faster moving average. The 26 represents the previous 26 bars of the slower moving average. The 9 represents the previous 9 bars of the difference between the 2 moving averages. This is plotted by vertical lines called a histogram, the green lines in the chart above. There is a common misconception when it comes to the lines of the MACD. The 2 lines that are drawn are not moving averages of the price. Instead, they are the moving averages of the difference between 2 moving averages. In our example above, the faster moving average is the moving average of the difference between the 12 and 26 period moving averages. The slower moving average plots the average of the previous MACD line. Once again, from our example above, this would be a 9-period moving average. This means that we are taking the average of the last 9 periods of the faster MACD line and plotting it as our slower moving average. This smoothens out the original line even more, which gives us a more accurate line. The histogram simply plots the difference between the fast and slow moving average. If you look at our original chart, you can see that, as the 2 moving averages separate, the histogram gets bigger. This is called divergence because the faster moving average is diverging or moving away from the slower moving average. As the moving averages get closer to each other, the histogram gets smaller. This is called convergence because the faster moving average is converging or getting closer to the slower moving average. And that, my friend, is how you get the name, moving average convergence divergence. Phew, we need to crack our knuckles after that one. Okay, so now you know what MACD does. Now we'll show you what MACD can do for you. Let's discuss how to trade using MACD. Because there are two moving averages with different speeds, the faster one will obviously be quicker to react to price movement than the slower one. When a new trend occurs, the fast line will react first and eventually cross the slower line. When this crossover occurs, and the fast line starts to diverge or move away from the slower line, it often indicates that a new trend has formed. From the chart above, you can see that the fast line crossed under the slow line and correctly identified a new downtrend. Notice that when the lines crossed, the histogram temporarily disappears. This is because the difference between the lines at the time of the cross is zero. As the downtrend begins and the fast line diverges away from the slow line, the histogram gets bigger, which is good indication of a strong trend. Let's take a look at an example. In Euro-USD's 1-hour chart above, the fast line crossed above the slow line while the histogram disappeared. This suggested that the brief downtrend would eventually reverse. From then, Euro to US dollar began shooting up as it started a new uptrend. Imagine if you went long after the crossover, you would have gained almost 200 pips. There is one drawback to MACD. Naturally, moving averages tend to lag behind price. After all, it's just an average of historical prices. Since the MACD represents moving averages of other moving averages and is smoothed out by another moving average, you can imagine that there is quite a bit of lag. However, MACD is still one of the most favored tools by many traders. This is the time to move with other lesson where we discuss how to use parabolic SAR. Up until now, we've looked at indicators that mainly focus on catching the beginning of new trends. Although it is important to be able to identify new trends, it is equally important to be able to identify where a trend ends. After all, what good is a well-timed entry without a well-timed exit? One indicator that can help us determine where a trend might be ending is the parabolic SAR, stop and reversal. A parabolic SAR places dots, or points, on a chart that indicate potential reversals in price movement. From the image above, you can see that the dots shift from being below the candles during the uptrend to above the candles when the trend reverses into a downtrend. How to trade using parabolic SAR. The nice thing about the parabolic SAR is that it is really simple to use. We mean really simple. Basically, when the dots are below the candles, it is a buy signal. When the dots are above the candles, it is a sell signal. Simple? Yes, we thought so. This is probably the easiest indicator to interpret because it assumes that the price is either going up or down. With that said, this tool is best used in markets that are trending, and that have long rallies and downturns. You don't want to use this tool in a choppy market where the price movement is sideways. How to use parabolic SAR to exit trades. You can also use parabolic SAR to help you determine whether you should close your trade or not. Check out how the parabolic SAR worked as an exit signal in Euro to US dollars daily chart below. When Euro USD started sliding down in late April, it seemed like it would just keep dropping like a rock. A trader who was able to short this pair has probably wondered how low it would continue to go. In early June, 3 dots formed at the bottom of the price, suggesting that the downtrend was over and that it was time to exit those shorts. If you stubbornly decided to hold on to that trade thinking that Euro USD would resume its drop, you would have probably erased all those winnings since the pair eventually climbed back near 1.3500. Let's come to the other lesson. How to use the stochastic indicator. The stochastic oscillator is another technical indicator that helps traders determine where a trend might be ending. The oscillator works on the following theory. During an uptrend, prices will remain equal to or above the previous period closing price. During a downtrend, prices will likely remain equal to or below the previous closing price. This simple momentum oscillator was created by George Lane in the late 1950s. The stochastic oscillator uses a scale to measure the degree of change between prices from one closing period to predict the continuation of the current direction trend. The two lines are similar to the MACD lines in the sense that one line is faster than the other. How to trade Forex using the stochastic indicator. The stochastic tells us when the market is overbought or oversold. The stochastic is scaled from 0 to 100. When the stochastic lines are above 80, the red dotted line in the chart above, then it means the market is overbought. When the stochastic lines are below 20, the blue dotted line, then it means that the market is oversold. As a rule of thumb, we buy when the market is oversold, and we sell when the market is overbought. Looking at the currency chart above, you can see that the indicator has been showing overbought conditions for quite some time. Based on this information, can you guess where the price might go? If you said the price would drop, then you are absolutely correct. Because the market was overbought for such a long period of time, a reversal was bound to happen. That is the basics of the stochastic. Many Forex traders use the stochastic in different ways, but the main purpose of the indicator is to show us where the market conditions could be overbought or oversold. Over time, you will learn to use the stochastic to fit your own personal Forex trading style. Okay, let's move on to RSI. How to use RSI, Relative Strength Index. Relative Strength Index, or RSI, is a popular indicator developed by a technical analyst named J. Wells Wilder, that help traders evaluate the strength of the current market. RSI is similar to stochastic in that it identifies overbought and oversold conditions in the market. It is also scaled from 0 to 100. Typically, readings of 30 or lower indicate oversold market conditions and an increase in the possibility of price strengthening, going up. Some traders interpret that an oversold currency pair is an indication that the falling trend is likely to reverse, which means it's an opportunity to buy. Readings of 70 or higher indicate overbought conditions and an increase in the possibility of price weakening, going down. Some traders interpret that an overbought currency pair is an indication that the rising trend is likely to reverse, which means it's an opportunity to sell. In addition to the overbought and oversold indicators mentioned above, traders who use the Relative Strength Index, RSI, indicator also look for centerline crossovers. A movement from below the centerline, 50, to above indicates a rising trend. A rising centerline crossover occurs when the RSI value crosses above the 50 line on the scale, moving towards the 70 line. This indicates the market trend is increasing in strength, and is seen as a bullish signal until the RSI approaches the 70 line. A movement from above the centerline, 50, to below indicates a falling trend. A falling centerline crossover occurs when the RSI value crosses below the 50 line on the scale, moving towards the 30 line. This indicates the market trend is weakening in strength, and is seen as a bearish signal until the RSI approaches the 30 line. How to trade using RSI. RSI can be used just like the stochastic indicator. We can use it to pick potential tops and bottoms depending on whether the market is overbought or oversold. Below is a 4-hour chart of Euro-USD. Euro to US dollar had been dropping the week, falling about 400 pips over the course of 2 weeks. On June 7, it was already trading below the 1.2000 handle. However, RSI dropped below 30, signaling that there might be no more sellers left in the market and that the move could be over. Price then reversed and headed back up over the next couple of weeks. Determining the trend using RSI. RSI is a very popular tool because it can also be used to confirm trend formations. If you think a trend is forming, take a quick look at the RSI and look at whether it is above or below 50. If you are looking at a possible uptrend, then make sure the RSI is above 50. If you are looking at a possible downtrend, then make sure the RSI is below 50. At the beginning of the chart above, we can see that a possible downtrend was forming. To avoid fakeouts, we can wait for RSI to cross below 50 to confirm our trend. Sure enough, as RSI passes below 50, it is a good confirmation that a downtrend has actually formed. So guys, we are finishing this video here only. In next video we will cover the remaining topics of popular chart indicators. So stay tuned.